Bruce, welcome to the show. We are here to talk about money today. So let's get things kicked off here and tell us a little bit about who's Bruce? Who is this guy and what is Insula Capital Group? What makes your guys' approach to lending money different than everybody else?
Okay. Well, Bruce is an individual who has been in mortgage lending for 30 plus years. I started as a processor, worked my way into a loan officer, worked my way into an account manager, did wholesale lending where I was the lender at Wells Fargo for 10, 12 years, working with mortgage brokers, teaching them about the products, the services. I wound up going into correspondent lending with a national lender where I was buying closed loans from other independent mortgage bankers. They were selling me individual, which is there was mandatory, and there was, what was the other one? Mandatory or I forget how it was done. The mandatory is when they sell us the paper, they have to deliver, and it's a mandatory delivery.
From the way that you're talking, I mean, you've been in this money game for a long time, and
Yes.
you've been on the other side of the table. What I love about what we're going to chat about today is I get to break it down and slow you down a little bit, like little things that you said, stips. So I'm imagining stipulations, and when you're inside of the box and you're talking about acquiring loans and then selling them, when you're inside of that box with banks like Wells Fargo, you're in that Fannie Mae, Freddie Mac box, and those stipulations are certain things that you have to hit inside of this to make sure that you get this loan in paper, and then that you can sell that loan. That's the paper trade that you have done for a really long time, right?
Right, that I did. So, yeah. I mean, I was the one in charge of making sure that the documents were correct, that the paper came in. So when you deliver a closed loan file, the paperwork has to be there. If the paperwork's not there and not correct, the loan doesn't get funded and you don't get your money. So my whole way of life was to make sure the files go in correctly and they get funded, because the faster they come off the warehouse line, the more money that my clients make. So
ATF. That's the best letters we're looking for when we're doing these
authorization to fund.
Bam! Come on, bring it.
On this platform, this Fix It Flip, Ground Up, and DSCR platform, it's all about investors who want to make money. I'm really concentrating on building my branch office here in Florida to go national, and with your help, of course, and partners like yourself, it's helping me grow. But I have direct access to Ed Stock, the managing partner, and when I need something to be stretched or to be added or to be removed, say the credit is not the greatest and they were looking for a 6-month interest reserve, which I just had a file close yesterday. They wanted 6 months interest reserve. They didn't have the experience that they told us they had. It was a little less than what they told us. The time frame that they closed the loans in were longer than they had stated. So they wanted a 6-month interest reserve. Of course, the borrower pushed back. It was a $13,000 interest reserve they wanted. He goes, I'm not closing the loan. He would have closed the loan. He would have found the money, I'm sure. But I went to Ed and we reduced it from a 6-month interest reserve of 13 and change to a 4-month reserve, about $8,200. So what that means is that when he goes to the table, he signed a note that said first payment due is January 1st. He called me saying, Bruce, I'm not paying this loan. I said, Wayne, the first payment is due January 1st, but you have a 4-month interest reserve. That first payment's coming out of the interest reserve. Your next payment is due February 1st. That comes out of the interest reserve. Yeah. The next payment is due March 1st. That comes out of the interest reserve. So Wayne, if you get rid of this house in 4 months like you said you were going to, you won't even have to make a payment because they'll already be paid.
Nice.
He goes, oh, okay. He goes, can I get that in writing? I said, sure. I sent it in writing. My managing partner, Ed Stock, sent it in writing. And, I explained it to him, but some people don't understand the concept. And I saw him last night at my meeting, and all he did was shake my hand and say, thank you so much. I want to get rid of this house in 3 months. I said, go for it. So a DSCR loan is a debt service coverage ratio. And debt service coverage ratio means the rent roll that you're getting from the property is divided by the PITI, PITIA, if there's an association fee. So if you're renting your property for $1,200 and your PITI mortgage payment, principal, interest, tax, and insurance, and association fees, if so, are $1,000, you divide the $1,200 by 1,000 and you get a 1.2 DSCR ratio. 1.2 DSCR ratio is kind of a standard ratio to be a profitable property. You can go below the 1.2, but the further you go below 1.2, the higher the rate goes because it's more risky of a loan. So the debt service coverage is, so when Dodd-Frank was enacted in 2010, the most important part of Dodd-Frank in the mortgage world was the ATR, the ability to repay the loan. So a DSCR, the ability to repay a loan was always tax returns, bank statement, tax returns, W-2s, pay stubs, right? That's traditional, Fannie, Freddie, FHA. You're not getting around it. Non-QM, non-qualifying mortgages were the DSCR, the bank statement loans, foreign national loans, ITIN number, ITIN borrowers. So that was a whole different realm. No longer subprime. Subprime doesn't exist. High cost doesn't really exist. So these loans are all designed, especially the DSCR, is to cover the ATR, the ability to repay the loan. So all 30-year fixed loans, DSCR loans, do get sold to the secondary market. They do go through a second level of QC before they can get sold to the secondary market because the ATR has to be met in mortgage standard. That is Dodd-Frank's law that was enacted in 2010, and that's how the DSCR became so popular. No tax returns, no pay stubs, no bank statements. Really, you don't, if you're doing a refinance, you don't necessarily need money in the bank because a lot of times it's cash out. But you're always going to need 2 months bank statement because it's a 30-year fixed rate mortgage. So they want to see that you have a bank account. If you're buying the property and you're putting 20% down, you're not using your income, you're not using anything, but you do have to show the 20% in the account as well as closing costs. I find a lot of people looking at properties that they don't make sense. And I myself do a calculation on every loan before I even intake it. So if you tell me you're buying a house for $300,000 and the taxes are $5,000 a year, and homeowners is $3,000 a year, and you're collecting rent of about say $1,500, I'm going to tell you, guess what? That's never going to work. Right. You're going to be underwater. That's not a good investment. So, a lot of times investors make mistakes because they're not really cognizant of what they need to make. I mean, I've closed loans with a negative DSCR ratio for people that needed to close the loan for some other reason, and it's who would want an investment property that mortgage payment is $2,000 a month and you're collecting $1,800 a month in rent. Bring your credit score as high as you can. I have had credit for many, many years. My credit is up in the 820 range. I can get credit and I can get the best term possible. Unfortunately, the industry gives the worst terms for the worst credit, where you would think that, they have bad credit, they need help. That's not the case. The case is the better credit risk you are, the better leverage you get, the more money you get.